A lot of folks, myself included, have spent much of the past month to 2 months buying up shares of legacy software as a service companies because we believe that they are being unfairly punished, that the age of AI agents and the threat that introduces to enterprise software stocks is being overdone, and that we are buying stocks that are going to rebound really well. But there is one huge threat, one huge error in that logic that I think many people are overlooking, and that's what we're going to talk about in today's video. I call it the switching cost conundrum, and at the end of the video, I will be showing you one technology stock that I believe can buck this trend. The goal here is to avoid a falling knife and find the real steal. So in this video, here's what we're going to do. We're going to define what a moat is. We're going to talk about the curious case of switching costs, because that's what enterprise software really counts on. We're going to talk about what AI agents do, the silent growth problem that leads many of us to believe that we've got really great deals, and finally, where an opportunity lies for you and where others might lie as well. Let's start off from the basic level. What is a moat? Because it's really important to understand that. It is a sustainable competitive advantage that keeps the competition at bay for months, years, even decades. We like to say that this is the way that capitalism works. Anytime you've got a product that proves to be really popular with people, you make a lot of profits. But guess what? People notice those profits, and they come with products to the market that are similar to yours for the same or lesser price, and that pulls down your profits, either because you lose sales or because you have to lower your prices. That is the force of competition, which is great for consumers, not so great for companies and their investors. The only way to buck that trend is if you have a moat. And there are lots of different opinions on there on what qualifies as a moat. In my world, I like to think there's 5 different moats. There are network effects. There are switching costs. There's low-cost production. There are intangible assets, and there is counter-positioning. Let's talk about all these. Network effects. That's where new users create value for existing users, and you can only benefit if you join the network. Think about a telephone. When telephones were first invented, they had no utility if you were the only person with the telephone. But the more people that got telephones, the more beneficial it was to have a telephone, and the more you might lose out on if you didn't have a telephone. Second, are switching costs. The way that switching costs happen is once you become a customer of a company, it becomes a pain to switch, whether because of time or money or training or business disruptions. I've held my money at the same bank for over 20 years, and I don't love that bank, and I'm afraid to pull my money and my accounts out of it because I've got so many other things connected to that account. Next, we have low-cost production, and that's where a company can produce the same or better product than rivals for lower internal costs. Now, sometimes those internal costs get passed on to consumers, as is the case in, say, a Walmart or a Costco. And sometimes those lower costs are for the benefit of the company, as in Amazon and their fulfillment network. Fourth, we've got intangible assets. And this really covers brand value, intellectual property and patents, and government licenses. And finally, we have counter-positioning. That is where the competition would have to give up sales to adopt your business model. Think about Netflix and Blockbuster. Blockbuster made most of their profits off of late fees. Netflix's business model eliminated those late fees. So if Blockbuster wanted to challenge Netflix, it would have to blow up its business model to do so. So that's what moats are. But now let's move on to the curious case of switching costs, because switching costs are the key moat for software and many technology companies. And what I want us to do is I want to think about every company that exists having 2 doors, a front door and a back door. And here's how this analogy works. The front door is where new customers find it easy to enter your ecosystem. That's what you want. You want to make it easy for customers to enter your ecosystem. The back door, on the other hand, is where existing customers, you hope as a business, are kept securely within your ecosystem. It makes it hard for them to leave. Now let's use this front door, back door analogy with the moats. With network effects, the front door is pretty obvious. Users are drawn in because they want to enjoy the benefits of the network, and they don't want to leave because if they leave, they lose the benefits of those networks. If I give up my phone, I've lost that way of communicating with other people. So the front door is easy to open. The back door is like a vault. That's a great business model. Let's next talk about low-cost production. The front door is pretty easy to go through. People want to benefit from the low cost or whatever it is that you can provide at a lower cost. And the back door remains pretty solid. Maybe not the same, but people don't want to lose access to that low cost. Good business model. Let's talk about intangible assets. The front door, again, pretty easy to open. People want access to that valuable intangible asset, whether it's intellectual property of maybe going to a movie that you enjoy or a brand of clothing that you really like. They want access to that. The back door is the fear of losing access to that intangible asset. And I will say that might sometimes be super strong, sometimes not as strong, but either way, the dynamics are strong. Now, it is worth pointing out that counter-positioning is a rare duck, and here's why I say that. The front door is very easy to open because people appreciate the benefits of this new model that someone is introducing. But it is worth noting that the back door is pretty weak. And it's not weak against incumbents. Netflix didn't have to worry so much about Blockbuster coming out with their own DVD by mail. But if the advent of streaming didn't actually arrive, it would make sense for other DVD by mail companies to crop up because upstarts can mimic this new business model. So that's a easy to open front door, but also pretty easy to open back door. But it's really important to point out all those dynamics because it brings us to switching costs. And this is really where the rubber hits the road with what we're talking about. With switching costs, it is true that the back door is painfully hard to get out of. And that's because it is painful to leave an ecosystem once you're in. That's the whole point of switching costs. You're forced to stay in. The front door, however, is also very, very heavy to open. It's very, very hard to get new customers to come in because they fear being trapped inside once they're in. The reason they enter or have for the past 15 years is because it was the only way to gain the benefits of the software that many of these companies had. So it's really important to keep in mind this unique aspect of switching costs. It is hard to get people in the front door, but once they're in, they stay. Because a lot of people have been talking about, hey, look, this company, that company, and I'll mention some names in a minute. They're not going to lose their existing customers, and that might be true, but it's missing the larger point. Enter the AI agents. And it is true that they might never touch those existing customers. In fact, those software companies will introduce AI functionality that their existing customers will probably enjoy. But here's the thing. This is the change. AI agents will fundamentally alter that front door, and the friction of finding and deploying solutions will change. The threat is that if a new business can use AI-driven, AI-native, cheaper alternatives, then they're not going to sign up with a legacy software provider. So I'll call it my first name here, Salesforce. Okay, Salesforce probably isn't going to lose a ton of their existing customers, especially the big ones. But if a Salesforce competitor comes along that offers the same functionality as Salesforce, and I'm not talking about an in-house vibe coding challenge here. I'm talking about someone that has much lower overhead and much lower costs and just a different business model. Well, then a new business that comes along that's being started today that focuses on something else entirely, well, they're going to want to go not with that legacy provider, but with the newer provider. And here's the thing to really remember is that given the amazing progress that large language models have made over the past 6 months, this new reality of these startups coming to market could be upon us faster than we expect. Now, here's why this matters. It's creating what I'm calling a silent growth problem. Now, here's what I mean. Some of the biggest companies of today didn't exist at all 30 years ago. Alphabet, Amazon, Tesla. They weren't around 30 years ago. But I do believe that the same dynamic of the huge companies of tomorrow not existing today is going to be true moving forward, only at an accelerated pace. The biggest companies, perhaps just a decade from now in 2036, the class of 2036, those companies are being started today. And those companies might not want any interest in being locked in to a Salesforce-like ecosystem. they might choose someone new, someone that is AI native. So that the front door problem with these 2036 giants is that they're not going to enter the legacy SaaS providers, the established platforms and gatekeepers. They're going to find an AI native or autonomous or decentralized alternative. They're going to bypass this traditional entry. They have no incentive to enter this legacy gatekeeper. But, and this is where I was fooled too, it's a silent growth problem because it won't show up in the numbers we see, at least for a while. Now, here's what I mean. If you are looking at the metrics, key metrics for many software companies like revenue growth or gross margins or dollar-based net retention, those are all going to appear robust, even anti-fragile, very healthy. But if you follow the dynamics of what we're saying is there's going to be some silent rot that's happening that isn't going to show up right away. That internal decay and core rot is going to come from those companies that are being formed today, not going through that front door that we just talked about. These are the Salesforce, the HubSpots, the Atlassians, the Workdays, the Monday.coms. You might disagree with these names. Pay attention to the dynamics. I'm just showing which ones I think might fall in this bucket. And here's why it matters. And here's why it might seem that there's a disconnect between the solid numbers that these companies are showing and investment analysts downgrading those stocks. Because an analyst is going to realize something. They're going to recalibrate for this silent rot. They're going to lower their terminal growth rate from, say, 3% just down to 1%, or their 10-year average annual growth rate from, say, 15% down to 5%. Why? Because they believe that that internal rot will show up eventually. And here's the thing. If you just make those two changes to a revenue growth rate and a terminal growth rate, well, guess what? What was once a $150 stock, if you change those assumptions, might just be a $65 stock. That's more than 50% lower, and that's what we see happening with a lot of companies today. And I'm not saying it's going to be exactly, it's going to fall a little bit more than 50%. We don't know. But the math on this actually does make sense to see them fall so much. So then the question becomes, well, where can I invest? Where is the opportunity for you? Well, I'm going to give you an example of 4 things to look for, but also a company that I think checks all 4 boxes. But before I do, I want to let you know that I have tracked my results from the end of 2014 up to today. These are my results as of the beginning of February this year. My results in the green, the NASDAQ composite in the yellow, the S&P 500 in the red. And I tell you that because I have a program that is just for you called Stock Investing Mentor. There are 3 parts to it. Part 1 is weekly, live, 1-hour sessions that are recorded where you're getting one investing nugget that you can apply to your own portfolio moving forward. 2, you get real-time access to my portfolio, every move I make with a video explanation of why. And number 3, 24/7 access to a private online investing community. If that interests you, click the top link in the show notes below, but it's worth noting that this deal will be gone at the end of the week on Friday at 11:59 p.m. All right, so let's talk about the opportunity for you. And that is going to be technology companies, especially software companies. And this is why that opportunity exists. Because while there is logic that makes sense for many of these software companies to have seen their stocks go down by so much, I do think the baby has been thrown out with the bathwater. This is a re-rating conundrum where some of these stocks definitely deserve this treatment. However, there are others that are high quality opportunities that have been thrown out that I don't think are in as big of an existential threat as others are. Now, what are the characteristics of these companies? Well, I think that they have 4. 1, they have a usage-based price model, not seat-based. So it's aligned with customer value, not humans sitting in seats using it. Number 2, it's hardware integrated with software, atoms and bits, which makes it more defensible. Number 3, there's a huge penalty for any mistake that these new models make. And so you want to stick with your legacy provider. And number 3, there are legitimate network effects where you actually do get a better experience or a better product the more people that are already using it. And one company that I do believe fits all four of these is Cloudflare, which started out as a content delivery network specialist, but has become many other things. Now, let me give you an example. While it's not 100% usage-based, a large chunk of its revenue is usage-based. It is integrated hardware and software, as it has located hundreds of data centers throughout the world so that 95% of the world's population is within less than 50 milliseconds of one of those data centers. Number 3, there are huge penalties for mistakes, as we saw when Cloudflare had an outage a few months ago and it knocked out much of the internet. And number 4, there are legitimate network effects. Look, this company has also become a cybersecurity specialist, and it helps to have more customers for that. Or it is also able to offer lower prices given the scale that it has accomplished. So that is the big mistake that I see a lot of software investors doing, that I think a lot of people are going to be having caught falling knives, myself included. Now, I've given you one example of a company that checks these boxes, but I'm investing in others as well. If you want to see what those are, again, top link in the show notes below to have access to Stock Investing Mentor for 10% off. Let me know what other stocks you think are falling knives or the great deals that are getting thrown out with the bathwater in the comments section below. Don't forget to hit subscribe the next time I update this dynamic, and until then, Brian out.